Hello, everyone, and good afternoon. It is my pleasure to be with you today, and this may be one of my last opportunities to speak with you from a partnership with the NBAC environment. My name is Janine Hooks, and I am now the director of the Columbus Urban League Financial Empowerment Services. We started this partnership with Fifth Third many years ago. We used to invite them into our parking lot with an actual with an actual bus where they would bring their Fifth Third bus that was completely wrapped and offer banking services on site and in person. Well, as you all know, times have changed and Fifth Third has pivoted perfectly to address us in our new environment with a virtual e-bus. So we are here today presenting to you the second of 3 workshops that's focusing on how to build your business from planning, how to build your business from a credit perspective, and then the third in the series will be how to use your business credit. So it is my pleasure to be here with my colleagues today that are helping businesses understand how to build their resources and their business acumen when it comes to business lines of credit. And today is a very important segment and session on that. Before I introduce our Fifth Third partners, I want to ask the new NBAC director, Mr. Jesse Mark, to unmute himself and show up on camera so he can say a few words to our audience today. Jesse, I yield the floor to you.
Hi, Janine. Good morning, everyone. Thank you so much for the introduction, Janine. It's funny that, you know, the e-bus, earlier in my career, I spent some time at Fifth Third, and I'm very familiar with the e-bus. I remember sitting on the corner of Agler and Cassidy many moons ago, soliciting new business accounts and personal accounts and providing assistance for folks in our community that we serve. So hats off to the partnership with Fifth Third. I'm excited to be here with the Columbus Urban League and the NBAC, and I'm sure that I'll be available for anybody who has any questions for anything related to money. And I'm looking forward to the presentation today. So thank you so much.
Thanks, Jesse. And it is really a privilege for NBAC to have you in their corner right now, because that's what our small business owners are really concerned about, is how to raise that capital, where it's at, what are the resources. So we're happy to have you on the team. And it's my privilege to be a colleague with you in this space. Next, I want to introduce our guest speakers for today, Ms. Loretta Humphrey. She is, and I'm looking over so I can get her title right, the Assistant Vice President for Fifth Third's Community Development Relationship Division. So Ms. Loretta reached out to us a few months ago and wanted to make sure that we knew that they had this e-bus opportunity and this curriculum that they're providing, and we were all over it and happy to be able to present that. Ms. Loretta, if you want to go ahead and unmute yourself and come on camera and say a few words, I will pass the mic to you.
Okay, thank you so much, Janine. And we certainly do appreciate this partnership with Columbus Urban League. We've been partners for a very long time. And you're right, Janine and Jesse as well. We have brought our bus to Columbus for many years. And with the COVID pandemic striking last year, we had to pivot very quickly and find another way to service the community. And our virtual sessions was a perfect opportunity to continue to connect with the community and continue to provide financial literacy and education to those that we serve daily. So I am not going to take a lot of time. I do want to, thank our presenter, Alyssa, for joining us. She is going to present the content for you today, how businesses obtain credit. And we hope you get a lot out of this presentation, and you can, if you could, reserve your questions to the end of the presentation, we would certainly appreciate that. Janine, do you want us to go on and get started?
Yes, please. We will
Okay.
Turn the controls over to you.
Okay, so I'd like to introduce Alyssa Oiters, and she is going to, and Alyssa, I hope I did not mangle your last name, but she is going to present the how businesses obtain credit. And again, any questions, please feel free to ask questions, but if you can put them in the chat and we'll address those at the end of the presentation. So I am going to share my screen. And we'll get started. Alyssa, I'm turning it over to you. Can you please unmute your line?
Hi, Loretta. Yes, this is Alyssa. I did want to notice, I'm not sure if you saw in the chat, we do actually have one of our other bankers that is presenting as well. Looks like
Great.
she is the first part of our presentation. If she's able to be unmuted, she can take it from there.
Oh,
So through the goal of this workshop is for our participants to leave with an understanding of what creditworthiness is, how to apply for credit, how to build their credit, and then the link between personal and business credit. Okay, so lenders often evaluate loan and credit applications based on an individual's or a business's creditworthiness. Okay. So what is
Okay,
creditworthiness? So we can discuss what is creditworthiness and what are the factors that lenders and creditors may use to learn about your financial history. So creditworthiness measures the ability of you and your business to borrow money and repay a loan. If lenders and creditors think you're likely to repay the debt, they will deem you and your business worthy of receiving credit. So before applying before approving your application, lenders and creditors evaluate your creditworthiness based on the 5 C's of credit, which are 5 qualities that demonstrate how risky it may be for them to loan you money. Okay. So
okay.
those
I
5
am still
okay.
struggling to get you guys to see me. I'm sorry, please go ahead. I'm still working on getting this set up.
I just have one question. Did our participants get a guide? Because there's some, I can kind of like point you to the page while we're waiting.
I believe I might have sent the guide. Yeah, the presentation view will not come up. I am sorry. It comes up in my thumbnail, but it won't open. So I apologize for that. It only
No worries.
comes up as a thumbnail.
Yep, no worries. These things happen. I appreciate the effort. It's Youngblood. The presentation will be sent out post the webinar along with the recording. So I think the best use of time right now would be really for you to kind of walk us through what you wanted to share relative to business credit, and then we'll get into probably a robust Q&A. How's that sound, ladies?
That sounds great.
Yeah, that's fine. Yeah, that's fine. My notes help me to direct you to those pages. So if they're going to send this webinar out and it's recorded, I'll just speak as if we have the presentation in front of us.
Perfect. And for our audience and our participants, we do apologize for the technical difficulties, but this is your great opportunity to take notes so that you have a higher retention of what's been discussed during this. And I encourage you to post your questions in the chat because you have the subject matter experts in the room. So let's make the most use of them. Go ahead, Ms. Youngblood. I turn the floor over to you.
All right, thank you. So we will be moving into discussing the 5 C's of credit. You can find these on pages 4 and 5. All right, so when you apply for a loan, the lender will evaluate your request to determine whether it is a good decision to lend to you or your business, any value of money. A common evaluation framework is the 5 C's of credit, which are capacity, capital, collateral, character, and conditions. All right, so we'll talk about these individually. We'll start with capacity. It's important for lenders because it shows your ability to repay debt from current and future income. So take a moment and ask yourself, do you have enough personal income and business revenue to to pay your bills, existing bills, and new debt? Has your business shown a sufficient history of profitability? What indicators are there that profits will continue to be sufficient into the future? Okay. So capital, moving on, capital is important to lenders because it indicates how committed you are and how much money you will lose if the business fails. You'll want to think about how much of your own money have you invested in your business. Are your assets higher than your liabilities? So they want to make sure that you have some type of money going into it. Next is collateral. This is important to lenders because it provides lenders a means to recoup or get back the loan in case you can't repay the loan as agreed. A loan is considered secured when specific assets or collateral are committed to a creditor in the case of an inability to repay the loan. This reduces the risk to the lenders. So you'll want to look at if you have any assets. So vehicles, real estate, any equipment that could function as collateral. Will this credit be used to purchase assets that can be used as collateral? So are we using this money to purchase the equipment or purchase the real estate? And then what is the value of those assets? That is very important. Next is character. This is important because it shows, great, it shows your trustworthiness and commitment to financial obligations. Do you have a history of paying your financial obligations in full and on time? Do you have a good track record of holding a job or managing a profitable business? And have you ever declared bankruptcy? Some of the conditions that we will be looking at, moving on to conditions, what opportunities and risks does your company face from changes in your industry or the economy? Conditions are important because they describe how you'll use the loan and whether the economy or other external factors will affect your ability to repay debt. A few more things to consider. What are the trends in your industry? Are similar companies expanding or contracting? What competitive edge does your business have? And how will the loan improve your business profitability, efficiency, and stability? Okay, so now that you know a little bit about these factors and what lenders and creditors consider when evaluating credit worthiness, we can put it into a scenario. So we'll move on to pages 6. Pages 6 and 7 will have the whole case scenario. All right, so we'll go over this. Jovina is a 46-year-old entrepreneur who wants to expand her small sewing business, Sew Right. She started the business as a hobby for her home and began by selling to her friends and family. 2 years ago, her daughter made a website for the business and sales skyrocketed. Jovina was able to start paying off her personal loans from the income. Jovina has 3 credit cards, 1 business, and 2 personal. She pays her credit cards and her personal loans on time. She always pays more than the minimum balance, but she has never paid off any debt in full. She owns a car that she has for 8 years and rents an apartment. Jovina hasn't had any other employment since having children 15 years ago. All right. So let's go ahead and consider this scenario. Just by reading this scenario, which C's or C's will Jovina's credit card history affect when a lender is considering whether to give her a loan? Give you guys a moment to think about it. So the correct response to the first question is capacity and character. So both of these, capacity and character, will be affected. Jovina's credit history of repaying loans and credit cards on time reflects positively on her character. Her capacity is limited because she has outstanding balances on her credit card. Okay. So next, let's consider the number of assets that Javina owns. Which C's or C will her asset ownership affect when a lender is considering whether to give her a loan? So just looking at this, based on the 5 C's we've covered, the one that would be affected would be her collateral. Javina, she owns an 8-year-old car whose value has likely depreciated over time. And since she does not own any other significant assets to put her collateral up, for collateral, the number of assets she owns will not likely negatively affect her ability to get a loan. So next, we'll evaluate how might Jovina's employment history affect her credit worthiness. So this could affect her capacity, which could be limited depending on her income history and ability to repay her past debt. It could also affect her character. And then just reviewing, how might her personal loan debt affect her credit worthiness. Her capacity and character, as well as the amount of capital she has to invest in her business, are things that they would consider. So now we know a little bit about the 5 C's. We'll move on to just a few other things that would be considered when it comes to credit worthiness. So the more prepared you are when you approach a lender, the higher the likelihood that you will receive the funding you're seeking. You should be prepared to answer questions when you meet with the lender to fill out your application. A lender is likely to ask you questions that fall into these five broad areas you see on the screen. So background and general questions. They may ask you, when was your business incorporated? Have you invested your own funds? And what personal or business collateral is available to secure the loan or line of credit? Second, they'll ask questions about management and employees, including team experience and composition. What type of experience do you and any other managers have? How many employees do you have? And are they full-time or part-time? Business operation questions about products and services, industry, outlook, and clients would look something like, what are all the products and services that your businesses provide? Are all of these lines of business profitable? Which ones and why? Who are your clients and how many do you have? Definitely we'll consider financial questions about your business financial history and the documentation of that. Do you have 2 or 3 years of financial statement plus interim current year statement? Do you have 2 or 3 years of business and personal tax returns? Is your business profitable and for how long? And lastly, some personal questions you'll want to be prepared to answer. And this will be centered around credit history, including bankruptcy. What is your or your family's personal financial budget, and what sources of income are available to cover your living expenses? Most lenders will provide you a personal financial statement for you to complete. But then they'll also consider, how is your personal credit? Are there any discrepancies that need to be explained, such as a divorce or a medical issue? All right, and they stated there will be a participant's guide that will be going out. So on pages 8 and 9, there's some other things to consider as well. So lender may ask many questions. So you just want to be prepared to answer those questions when going in to apply for a loan, so that they can understand your business better. and then I will push it off to Alyssa, who will begin speaking about building and maintaining good credit.
Good morning. My name is Alyssa Aders. I am a personal banker at our Dublin, France Road location near Columbus, Ohio. Thank you all for being here today. I'll go ahead and continue off where we left off there. If we could go, perfect, we're on the slide already. All right, so let's talk a little bit about your personal credit. A good personal credit score is key to obtaining financing. While many lenders will evaluate your business comprehensively, as we discussed previously, some will look at your credit score as the primary indicator for their decision. This is especially true for young or small businesses. There are two types of credit scores: personal credit scores and business credit scores. Unless you are a larger business, most banks will look exclusively at your personal credit score and report. Your score is calculated by an independent agency that tracks a variety of information on your credit report. So, what strategies can you use to build your personal credit? That's going to be more like obtaining a credit score, paying your bills on time, and keeping your credit card balances low. All right. And these are great strategies. To build good credit, you must first start using your credit wisely. So let's review the top reasons why scores go down and how to improve those scores if they do tend to drop a little bit. Top reasons why credit scores go down are late payments, collections for 7 years after the occurrence, so those will maintain on your credit report. Bankruptcies, those are going to be 7 to 10 years. High debt compared to your income, which we often refer to as your DTI. Too many recent credit inquiries, those are going to be in the past 12 months. Charge-offs, which are when a consumer becomes severely delinquent on a debt, those are going to stay on there for 7 years. Any balances that are deemed too high. So here are some tips for improving your score. Making sure that you are paying all of your bills promptly. Keep low balances on your credit cards. Don't take on too much debt. Stay at the same job and address for as long a period of time as you can. Read and understand your credit report. Make written inquiries on items you believe are incorrect. So, paying bills in full and on time is one of the best ways to build good credit. Page 10 of your participant's guide lists some of the actions that can help build and maintain that strong personal credit score. So, how are business credit scores and reports different from personal ones? If we could move on to slide 8. All right. So, this is going to be looking at page 11 when you do get that participant guide. So, if you are running low or running a new or small business, it's likely your business won't have much of a credit history. It's going to be a little bit lower to start out, and you'll work on building that up. Lenders will often rely on the business owner's personal credit report and score when deciding whether or not to approve loans to their business. Now, when you get that participant guide, you can take a look at page 12, that's what we're referring to now, or take notes as you wish through this. How might a lender use a business credit score? So lenders may use that business credit score to decide if a business is creditworthy, approve or reject loans, determine whether a business is legitimate or trustworthy. Now let's compare business and personal credit scores. There are a few important differences between personal and business credit scores. These scores are calculated based on data in your credit reports, which are created by different agencies for business than they are for individuals. Personal credit scores can range from 300 to a perfect 850. You can access your score for free at myfico.com or get a free score from any other company such as Vantage Score. Although Vantage will give you a score that's close to your FICO, which can be helpful, mortgage lenders typically use the FICO score. Business credit scores range from 0 to 100. You can access your score for free from Dun & Bradstreet. That's going to be businesscredit.dnb.com, Equifax Business, or Experian Business. You can also access your score for free using Capital One Business CreditWise. All that information is going to be in that packet that you'll receive at a later date. Another business credit score is the FICO Small Business Scoring Service, the SBSS score, which pulls your personal and business credit and ranges from 0 to 300. All right. Your business credit score reflects information that appears on your business credit report. A credit report is a summary of your financial history. The information in the report is used to calculate your credit score, which helps us as lenders decide if you or your business is worthy of a loan and if you are likely to repay a loan. So let's work on differentiating between your personal and business credit reports. The business and personal credit reports are similar, but they're also very different in many ways. So how are those similar? Both personal and business are used to decide if a business or individual is worthy of a loan. And they're also both used to see if the business or individual is likely to repay a loan. So a little bit about how they're different. Personal reports draw from information about the individual and his or her transactional history, while business reports draw from information about the business and its transactions. Lenders can compare a business report to those of other businesses in the industry and evaluate how company the stable is. Lenders may use both personal and business credit reports, but suppliers will use a business credit report as a deciding factor. So for example, when deciding whether you can extend a line of credit to that business, you can access one free personal credit report per year from each of the 3 main credit bureaus. Those are Equifax, Experian, and TransUnion. Due to COVID right now, I believe it has actually updated that you are able to retrieve that personal up to 6 times per year without impacting your score, and that is until the year 2026 due to COVID. You can access one free personal credit report per year, like I said. For the business, you can take a look at Dun & Bradstreet, Experian, and Equifax, or for free from that Capital One Business CreditWise, like I discussed previously. As you can see, lenders use your business and personal credit when making decisions about loan application. So what are some steps that you can take to improve or maintain your credit? Like your personal credit, it's important to maintain good business credit. The most important tip to maintain good credit is paying your bills in full and on time. It's going to be the most important thing that can help for you. To build your better business credit, you should pay your business credit card on time, keep business credit card balances low, and pay in full at least occasionally, but make sure you are always paying at least the minimum payment on there. Apply for and receive Data Universal Numbering System, which is a DUNS number from Dun & Bradstreet, and a tax ID number from the Internal Revenue Service, the IRS. Subscribe to a credit reporting service such as Equifax, Dun & Bradstreet, or Experian to monitor your credit and your strength. Make sure that your business information is accurate and up to date. Establish trade lines with vendors and encourage them to report your good credit behavior back to the credit bureaus. So on page 13 of that participant guide, there is a checklist of ideas of steps that you can take to establish business credit and keep maintaining that good business credit history. So we'll take a look to review the checklist. When you receive that, let us know if you have any questions through there.
Alyssa, one moment, please. Can you give me the title of the slide that you're on? The PowerPoint doesn't track with the facilitator's guide.
Oh, sorry about that. Steps to good credit. Looks like you're on it right now.
Okay, great. Thank you.
Yep.
Just let me know when you want me to advance.
I'll let you know and move forward. Perfect. Thank you. Okay. So to establish that good credit, you must maintain and use your credit responsibly. So how do you apply for a loan? You may have already applied for a business loan, but it's always good to review this process in case you need to apply for additional funds in the future. So let's talk about what information you may be required to provide a lender. If you'd like to advance to the next slide. In your participation or participants guide, you'll actually receive this full list as well. If you've already applied for a business loan, you're probably familiar with the process and necessary documents that most banks require. If you have not yet applied or plan to apply in the future, for funding, it is important to know what you'll be required to provide a lender. So I'll have you refer back to that participants guide when you receive that, but what we're looking for is the business credit card application or business credit application, personal credit report. The bank will pull that, 2 or 3 years of personal tax returns, depending on the credit request, 2 or 3 years of business tax returns, again, depending on that credit request, 2 or 3 years of business financial statements, plus those interim credit year statements, current year statements, current personal financial information, copy of sales contract or purchase order if you're purchasing equipment or real estate for the business, documents for any current loans or business lease agreements, your business license and proof of a business checking account, disclosures if you own any other businesses or if your business has any partners, and then a business plan. It's always a plus, but not required. So why do lenders want to see 3 years of financial statements and a tax return? These documents show us whether or not your business is profitable and has the capacity to repay the debts of any loans. What does having a business plan show the lender? It can show the path for your business's future growth and any industry challenges it may face. And why would a lender want to look at a sales contract? Secured loans require collateral, so that can be helpful for us as a lender to know what businesses have assets and what you own. All right, so let's move on to a little bit about an activity here. We'll review the checklist, see if you guys have any questions. I know we're holding those until the end, so we'll have a moment for you to review everything there. The checklist will give you an idea of the steps that you may need to establish business credit. So I think you've all had enough time to kind of review this checklist here. So we'll move on a little bit here since I know you guys don't have that participations packet yet. Another form of financing for small businesses is through the Small Business Administration. So it's going to be our SBA loans. All right, if you'd like to move to the next slide. All right. So the Small Business Administration partners with financial institutions to help our small businesses that may not qualify for traditional loans. The government program reduces the risk for lenders by providing a partial guarantee if the business defaults on the loan. So ask your lender what programs they offer and if you may qualify for these SBA loans. Some characteristics of the Small Business Administration financing includes the following. It is a loan from an SBA-approved lender, and SBA guarantees a portion of the loan. It helps the borrowers qualify for competitive interest rates and financial plans. The SBA backs a portion of the loan, but does not offer the loan directly to the individual. Loan amounts typically go up to $5.5 million, but caps may be varied based upon your industry. The SBA provides mentorship as well as access to loans. Veterans, women, and other groups may be eligible for special programs. Options include short-term SBA Express line of credits and loans. All right. Then on page 16 of that participant's guide that you'll receive, we'll move on to the pros and cons of that Small Business Administration financing. So if you'd like to go to the next slide. There are several main types of SBA loans for small business owners. So let's review some of the similarities and differences between these products. The 7A loan program, the maximum loan available is $5 million. It is a government guaranteed loan. These loans are offered for general business purposes, including working capital, expansion, and equipment purchases. They are longer terms and potentially lower down payments compared to other finance options. the 504 loan program. The maximum loan is available $5 million to $5.5 million, depending on type of business and the project. Loans are offered to owner-occupied real estate acquisitions, construction, and heavy equipment purchases. Borrowers pay 10% down as that first payment. Right. So most SBA loan programs have a long application and take some time to get approved. The SBA Express loan program has an expedited turnaround time of 36 hours. The maximum loan available amount is $350,000. The business must be operational for at least 1 year. The line of credit or fully amortizing loan when you pay back the loan in regular installments with a partial government guarantee. Loans are offered for working capital, equipment, business acquisition, real estate purchase, or facility expansion, seasonal line of credit or inventory, or to refinance debt. The interest rate is negotiable between the lender and borrower, but may not exceed 4.5 to 6.5% over the prime rate. The down payment can be as low as 10%. Borrowers pay an upfront guarantee fee amount dependent upon the loan amount and maturity of the loan. So we move on to our micro loans. The maximum loan amount is $50,000, and those loans are made through nonprofit organizations that may help small businesses with small-scale financing and technical assistance for startup expansion. All right, so let's talk about qualifying for that SBA loan with a quick activity here. So let's take a couple minutes to complete. Looks like there was a checklist in the participant's guide. Let's see here. Looks like that is just going to be in the guide, so we'll move past that for now. Take a look at that on page 19 in that guide. Quick little activity for you to review, go through and complete that checklist, see what criteria is missing for those business applications. And then if we could advance to the next slide here. All right, there are many alternative sources for funding for small businesses, especially those that may have trouble qualifying for a traditional loan. So let's take a look at a few of those. So if your financial institution partners with a local or alternative funding organization, there's different organizations that can be connected there. Community Development Financial Institutions, or CDFIs, are nonprofit organizations. They range from banks to credit unions to some venture capital providers. They work primarily at the community level to provide business mentorship, financing, and technical assistance to borrowers who may not qualify for traditional financing. Their goal is to foster thriving economic communities by empowering small businesses. CDFIs run a host of programs for small businesses. Examine each one carefully and decide which one for your business is the best and has the best qualifications. Depending on the composition and structure of your organization, you may qualify for additional loan programs. Many lenders have special programs for businesses owned by Native Americans, women, minority groups, individuals with disabilities, and those who are economically disadvantaged. There may also be programs through state or local economic agencies. We have partnerships that allow us to explore many alternative funding options for small businesses. Right. And then while many entrepreneurs invest some of their own money into companies, funding sources such as small business loans and credits can be essential when helping small businesses. So if you'd like to go to the next slide, wrap things up here. So obtaining credit and using it wisely is very critical to having a successful business. I really hope that the information we've covered today will help get your business's credit needs met. I'd like to open things up, see if anybody has any questions, anything we can help with.
All right. Well, I thank you both, Ms. Youngblood and Ms. Oders, and the Fifth Third team for getting that presentation up, for talking us through it and really being unflappable while we were working through our technical difficulties. So audience and participants, and anybody from the MBAC staff, go ahead and start posing questions in the chat that we can present to our subject matter experts while they are here with us. Jesse, I'm going to ask that you kind of come on camera as well and weigh in with your financial background and expertise on some of the things that you heard today. I will say, for one, I love the situational vignettes that kind of helped us think about people and real situations and what are the answers to that and how would one work through it. I thought that was a really good bit. I might actually steal that for some of my future programming. Jesse, what did you think?
Excellent information, very, very clean, clear, concise. I will add one thing on to the whole accessing capital piece, which is very, very important for all business owners, entrepreneurs. Make sure that you have that owner's equity portion, right? The not the sweat equity, but how much money you have to support the project. You know, every lender, banks, CDFIs, whoever it is that you're talking to, they're going to know that you have a cash position for money either saved or something that you have spent money on in the short term, so that it can support the project and the capital request. It's uber important for you to have that skin in the game, you know, because you know, it kind of comes back to the capacity component, to where, you know, you can do the work, do the job. You need to know that you have some money set aside for yourself for anything that, for the unexpected, so to speak, right? So I'll definitely tell everybody to make sure that you take a look at that for whatever it is. And in most cases, you know, it's 10 to 20%, depending on what type of project that it's going to be. But the SBA is looking at a bare minimum of 10%. Right now, as it stands, I know that the SBA, that they're forgiving the 2.5% fee. So it's 10%, but generally you're going to be looking at 12.5 or so for folks. So I just want to make that a point for what you're thinking about when you're looking to go and access the capital.
Excellent. Here's a question while we're waiting for questions from our audience. Oh, here's one from Ashley. Does a 10% go directly to the loan?
No, it does not. In my experience, I can get some input from the other bankers, but I would say no, it doesn't go towards the loan, but it goes towards the project. So, you know, if you're requesting $100,000, right, you'll want to have at least 10 grand sitting aside for anything that's incidental. So it doesn't go into the loan. So you're not paying it into the loan as a fee. It's just money that you have set aside for yourself to operate the business, or to, you know, buy the property or buy the equipment or whatever it may be.
Excellent. Here's one question that I fielded often in the MBAC office. And, you know, people were being very candid and honest, and many times they were concerned about adverse information on their personal credit history, and how that seemed to be a roadblock or an obstacle to them obtaining the capital that they were looking for their business. Can we speak to that, Fifth Third panelists or Jesse?
I can take the question to the third. If you want to, you know, jump on it, feel free to do so. I'll defer first, and then I'll play cleanup if need be. Or if we get crickets, I'll take it and run with it again. Ms.
To
Youngblood?
be clear, the question was how your personal credit will affect you when obtaining business credit. You said that there were like adverse marks on their credit report.
Right. Life has happened. I've got some adverse things on there, but I've got a business and I'm running with it, but I need to build capital at this point. And I'm hesitant to approach the bank about building that business credit. Can you help walk us through the thoughts there, and how they should be encouraged to fix it and then move forward?
Well, I can tell you here at Fifth Third, we love to help our clients reach their financial goals. So just hearing that, somebody who's, you know, apprehensive about speaking to the banks or anything, don't. You know, we're here to help. In thinking through something like that, an adverse mark on your personal credit being, my first thought would be, let's review that. Don't be scared to review it. I think that the best thing to do would be to tackle it. So we know that it's there, let's tackle it. That could be something that would prevent you from getting a business loan. So my thought process would be, let's figure out how we can take care of that. You know, we understand life happens. Let's make a plan, figure out how to take care of that so that we can move forward. Don't just stop, because a lot of times people be like, oh, well, my credit isn't the best, and then they never move forward with it. We want to keep going. You know, don't let that be a roadblock for you. You know, come in, see one of us or one of your bankers elsewhere, whatever the case. But yes, don't be afraid to try to tackle it now. That way you can continue to move forward in your business endeavors.
I love that. I mean, just, you know, the encouraging message, don't stop, you know, and no doesn't mean not yet. So be encouraged that, you know, there are things that you can overcome that can be fixed or corrected. You can work your way out of that negative situation and move forward with your business. And I would love it, Ms. Youngblood and Ms. Oders, if you could put your contact information and your branch information in the chat for our audience, because of the fact that you're local is important to us, because we want people to know how to access you. I'll go ahead and look through the questions we have here. Can we have a copy of the PowerPoint? Absolutely. At the end of this webinar, you will receive not only the video, but the handout that they referred to in the conversation and presentation of the message here today. Next question. This is a good one. When you just start a business, okay, is it possible to get a loan from the bank? If yes, what are the requirements to get the loan?
I think we may have touched on that in one of the earlier slides for some of the like the checklist, so to speak, what you need. Every bank is going to have, you know, some different criteria for what they want to have, different overlays that they may need to get. But if it's an SBA loan, those are all, you know, standard forms that somebody would need to complete, you know, personal financial statement application, you know, personal tax returns, business plan if it's a startup, of course. You have to have a business plan if it's a startup. I did see on one of the slides, you know, it may be required, or you may want to have it, and you know that's really for established businesses that if they're in a stay-up phase or scale-up phase. But startups definitely want to have a business plan. From what I've seen in my experience, at least a minimum of 3 years projections. With that, those are things that we can assist you with. I wanted to touch base, kind of piggyback on one other thing when you're talking about, you know, derogatory items as well. You know, to the point that if it's a no, it's not a no, maybe a not right now, to Ms. Youngblood's point. But if you do have some derogatory items on your credit, set up payment arrangements. Show that you've made that effort to make things better for yourself. And that is a narrative that the bankers or the lender is going to be able to help assist you with when they're talking about that character component for you when you're trying to get the money. Okay? You can't miss it. That's a huge point. You know, if you do have some, you know, lackluster items on your credit, right? You know, or you went through some struggles through the pandemic. We all get those things right now. But if you're trying to fight up the hill and you're trying to dig out of it, and you have that track record of payment arrangements, or showing the energy towards making those things better, that accounts for a long way as well.
Excellent, excellent. I want to ask a question of our participants in the chat. Participants, will you share with us how many of you have set up your DUNS number through Dun & Bradstreet? Go ahead and just say, yes, I have, or no, I haven't. So we know how far along in the business credit process you are. Excellent. Oh, okay. Okay. I love to see it. Good stuff. Who else? We've got a couple that have responded that yes, they've set up their DUNS number and that they have a Dun & Bradstreet credit report and a score. That's fantastic. Good stuff. Okay, so you guys are on it, So what's the most important thing as you're thinking about the fact that you've gone this far, you've taken this next step, you have moved from personal credit to establishing your business credit, that you really want to know from our Fifth Third partners, or how MBAC can help you grow your business or take it to the next level? Go ahead and put that in the chat while we're waiting on some other responses. And while we're looking at the chat, I'm going to ask our bankers, Ms. Otters and Ms. Youngblood, to share with us one thing that you wished every business owner knew before they got to your office.
How to
Bankers.
register their how to register their business. When you come to open up a business account, not many things that you really need, but you do need your EIN number. You need your business registered in the state of Ohio or whatever state you plan to get your business account. But I would say that would probably be one thing. I've helped quite a few people try to walk through it, give them some resources to where to go to try to register their business, but that and their EIN number.
Awesome. Okay. Good to know, business owners. Be prepared. Have your business registration done and in place. And if you don't know how to do that, we here at MBAC and at the Columbus Urban League can certainly assist you with that. Ms. Otters, what's one of the main things you wish clients knew before they came into your office?
I think for me, the biggest thing is going to be saving all of your paperwork. Make sure that you've got a great filing system to keep track of things. Like we said earlier, you need up to 3 years for different things. So make sure that you're hanging on to things, file them, get them uploaded electronically so that you can refer back to them through different times so that you've got them whenever you need them. So we can be prepared and make sure to get through the process faster, make sure we can get you your loan funding, things like that.
I love it. I love to hear it. So I'm just going to be really brutally honest here. Get your paperwork out of an envelope. out of the dash of your car, take your receipts, get them organized, find a CPA that can help you get that all put together so you've got a nice package to present to your banker. The other thing I will emphasize is, as we are still in the midst of COVID and many of our businesses suffered, drastically and terribly due to the impact that it had on their business, that some of us just weren't prepared, because we didn't have the banking relationship. We didn't have that connection where we could pick up the phone and say, hey, Miss Youngblood, I need to apply for these recovery funds, or I need to raise some, get some capital for my business. A lot of us are operating without that solid banking relationship. So now is the time to, if you haven't done it, you need to do it. And you've got people right here on the line that can help you with that banking relationship, and they're sharing with you the things that they really want you to have when you show up in their office, and they're more than willing to help you get yourself in order so that you can move forward and advance your business in the way that you want to. We have another question from Mr. Smith. What are the most important factors in improving the size of the financing package? So Mr. Smith, I'm assuming you're thinking from small, medium to large size loans. Could you give us a little bit more around that question for our bankers? And if, correct, okay. So what's the difference between most important factors in improving the size of the financing package from 50,000 versus 100,000 or more?
I think that it's really, it comes down to the source and use of funds, so, a banker's going to want to know what you're using the money for. If you're going to, buy a piece of equipment and it's $50,000, you're just trying to start up and get running, and, it's going to take you a little bit of time to start to generate revenue based off your business plan, and business plans have to be flexible, of course, but, you may need, a couple of months of working capital. So if you're buying a piece of equipment for 50 grand and you know that you're not going to start to turn a profit or actually get to the black for, 3, 4, 5, 6 months, whatever it may be, then you're going to want to ask for that cushion to be a part of that project for you as well. So it really comes down to the source and the uses of funds for what you see as a part of the request is, because then you're going to be able to have that conversation with the banker to put the square peg in the square hole if need be. And that's really what it comes down to, is having a concise business plan and a strategy for what you're trying to accomplish with that capital request.
Excellent answer. I couldn't have said it better myself. And make sure that your projections, if you're a new business startup, that your projections make sense, right? And don't ask for too little, because if you're underfunded, your chance of success becomes very, very slim. So you want to make sure that you're asking for the right amount of money you can justify why you're asking for that. So excellent, excellent. Well, listen, guys, our time is up. I want to thank our presenters. Fifth Third Bank has been an amazing partner. We have another session on next week, and I hope everyone comes back for that session. We have their contact information there. I appreciate Jesse for being available to kind of share his knowledge and really kind of get his foot wet a little bit with how we're doing these presentations for you all. And you will receive your contact, not your contact information, but your presentation information and a copy of this video probably on tomorrow. If you have any questions or concerns, back information is there on your screen. I thank you for your time today, and we all look forward to seeing you next week. Have a great and marvelous afternoon. Bye-bye.